Sure. So therefore, if I were to kind of, we've spoken about growth, globally, how things are looking and how is it looking for India. And specifically, we spoke about the earnings cycle, but the big elephant in the room is interest rates. On interest rates, I think there was a particular narrative, I think at least until last week, where, you had the new Fed chairman talking about inflation control. But suddenly, I think in the last 48 hours, that narrative seems to have, had a jarring kind of a halt when markets are suddenly believing that probably the Fed chair is not doing enough to kind of get inflation under control. So we've seen all your bond yields go up. India not as much, and while we'll come to that, 20-30-year bond yields at 20-year highs, negative implication clearly for risk asset. I mean, I don't think there is any other way to look at it. Then how do we kind of look at Indian equities? Because I also want to bring in the fact that while interest rates are going up and Indian equities have remained flat from a headline number, at least if you look at the Nifty, markets aren't really cheap, right? So rising interest rates, Indian markets being not very cheap, how should one kind of put this together?
So yes, I think firstly on this whole Fed pivot, if one could call it that, I mean, from whatever one reads, from what people are taking away from there, I think they are probably trying to craft a smart strategy where, this chairman has been welcomed by the president as someone who is going to deliver the interest rate cut that he has been wanting for such a long time. And understandably, the chairman, who is a technocrat professional who understands economics and markets so well, is between a rock and a hard place.
Clearly.
Because here is the person who's got him in waiting with bated breath for him to cut rates, but the situation on the ground just does not afford him that space. So what is it that you do? So you just let the markets do it for you. So that's, I think, what he's very smartly done, and he said it also, I think, very nicely, that in the last 6 weeks that he's been around as the chair of the Fed, the markets, and he wants to listen to the markets, and the markets have spoken. So I think he's letting the markets do his job, and therefore, in a way, probably abdicating his responsibility there. But by doing that, he is just ensuring that, while of course it's very nice to say that the markets are leading bond yields and therefore are getting priced fairly, it is going to lead to a lot more volatility because he doesn't believe in giving guidance.
Correct. And
therefore he is leaving the market a little unanchored.
But it never ends well, right? Letting markets lead.
Yeah, so I guess this is all a part of maybe a smooth landing that he's trying to get in what is appearing to be a very difficult situation. Therefore, there are multiple issues where people are beginning to get concerned, because while saying that price stability is important and 2% is sacred and so on and so forth, he's also said that PCE is probably not only the only indicator to look at, which then opens up a Pandora's box, because then you're saying that by using several indicators, you will try to kind of
still okay.
Yeah, you will try to maneuver your way around. So I think these are all raising issues of control, credibility, all of those issues. But I think he is probably trying to steer a smooth landing is how I would see it. Now, how could this play out? Is, of course, you could see a bear steepening happening in yield curve, which is already started.
Correct.
You already started seeing that. So therefore, the long bond yields are going up, and therefore extracting a price from the economy and from probably even global capital flows.
Risk assets, clearly.
So that is going to happen. But I think, in a way, that probably will get adjusted through the dollar weakening. So if you notice this time,
we've seen a little
just
bit
before
of that.
the policy, until up to the policy, the dollar was showing a slightly strengthening trend.
We were at about
101.6 or 7 thereabouts. Now, after the policy, you've seen it come below 100. It's below 101. So it's at about 100.8 or thereabouts. So probably that's the way the market is kind of readjusting itself.